Have you ever heard of the net worth trap? This week, we're speaking to a qualified and well-recognized academic who has done some research with regard to the net worth trap and what it means for the psychology of investors.
This is Make Better Wealth Decisions, a podcast dedicated to helping pre-retirees and retirees manage risk and economic uncertainty by adopting a pension-style approach to improve your risk-return trade-off. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto.
This week, we're speaking with Gautam Gopalakrishna. He is an assistant professor of finance at the Rotman School of Business at the University of Toronto. He received his PhD from École Politique Fédérale de Lausanne and the Swiss Finance Institute, and previously he was the visiting scholar of the Bendheim Center for Finance at Princeton University. Gautam, how are you today?
I'm good. Thank you so much for having me, John.
It's a real pleasure. I heard of your research only recently, and I wanted to talk to you today about your 2024 paper that you co-authored entitled Beliefs and the Net Worth Trap. And I got a chance to look at it, and I don't think I can do it justice, so I'll leave it for you. Can you please explain to me what that paper teaches us?
Sure. So let me give you a very short summary, and then we can talk about it in detail. So the main question we are after in the paper is how beliefs about the long-term growth rate of the economy affect macroeconomic outcomes as well as financial stability of investors. The key finding in our paper is when the key risk takers in the economy form distorted views of the market, then bad shocks will drive down their wealth to the point that it becomes harder for them to rebuild. And we call that phenomenon net worth trap. A consequence of this net worth trap is that capital in the economy will now move to the less productive and less efficient agents, and that will cause permanent inefficiencies.
I think that's interesting given where we are in the economy today in April of 2026. So I'll go into that maybe toward the end of our discussion, but maybe offer a little more color and detail about how beliefs can shape macroeconomic and financial stability. How do beliefs shape the way we think about stability and the way things work?
Right. So we built a specific economic model to nail this point. So in our model, there are two groups of investors. One, a rational group of investors who have the correct beliefs about the market. And then there are experts, so to speak, who are better at managing capital, but they form distorted view of the market. Now, the point here is that in good states of the world, these experts, so to speak, borrow from the rational investors and take leveraged positions in capital market. So if you think of the economy as a whole, these experts are disproportionately more involved in capital market. Now the question is, what happens when a negative shock hits? What happens to the balance sheet of the experts under two cases? One, when they have rational beliefs like the other participants. And second, when they have dogmatic beliefs, so to speak. By dogmatic, what I mean is they are either too optimistic or too pessimistic, and they are fatally not learning from the data to revise their expectations. Now, if they are irrational, what ends up happening is when negative shock hits, they lose their wealth, right? Because they are disproportionately more leveraged. And if anybody has taken a leveraged position in the markets, you know that leverage is fantastic when in good states of the world, when returns are positive, but then it's fatal when a negative shock hits. The same thing happens to the experts group in the model. They lose their wealth. What happens is because of the fire selling mechanism, that is all experts are selling capital price falls and risk premium rises. What does risk premium mean? It is a proxy for the future returns. Because price is going to mean reward, that means that in the future, they are going to earn higher returns if they are still involved in capital market. Now, this channel will help them rebuild their wealth. However, when they form dogmatic beliefs, when they form too optimistic beliefs or too pessimistic beliefs about the market, the expectation errors kind of creep into their profit. At some point, this expectation error is going to dominate the risk premium channel. And that will mean that the wealth will remain low for a very long period of time. So that is the key finding that shows how beliefs or belief distortions of the more productive users of capital can lead to permanent inefficiencies.
What you're talking about sounds a lot like, but not exactly like, a well-known phenomenon called the wealth effect. The wealth effect is a little more pedestrian. It doesn't involve leverage. It doesn't involve people who have inside knowledge and sophisticated backgrounds. It just means that people behave differently when they're doing well. How would you compare and contrast your findings with something which is maybe a little more well-known, which is the wealth effect?
It's related to the wealth effect, but not quite. So here are the key differences. Wealth effect is about how your wealth goes up or goes down and how that makes you feel. Whereas the net worth trap phenomenon is particularly about the rebuilding process. It's about the growth rate of your wealth and not the level of your wealth. The key finding here is that when the wealth level of the expert group or the financial intermediaries are very low, the beliefs that they form in that particular state of the world will matter quite a lot. It's not about the beliefs that you form when the economy is in good state. It's particularly about your beliefs in bad states of the world. Your belief distortions will end up affecting your wealth in a way that it will hamper the recovery process. And that is the net worth trap phenomenon. And that's how it's different from the wealth effect, which is the level effect.
So I'm also wondering about another distinction that I'm hoping you can just clarify. I think I know the answer, but I want to hear it from you, which is stocks versus flows, and net worth, which is a stock, versus your income level, which is a flow. What I'm hearing you talk about is the way your attitudes change based on wealth, the stock. Does your flow, does your income level, and I think as a result, the ability to recover, have any impact on your research?
The paper has both these effects, right? So there's the level effect, the stock effect, because at the end of the day, what determines financial stability or instability is the share of wealth held by these groups of experts. So in that sense, there is this wealth effect, but it's also about the flow effect, because the way you rebuild your wealth depends on how much premium you can earn and the intensive margin of how much you can move your exposure to the capital market. So in that sense, both these mechanisms bite into the recovery process in the model.
So if being either overly optimistic, which is stop trying, if you lose money, you say, I'm gonna stop trying because I've lost, or being overly pessimistic because I'm gonna stop trying because there's no way I can earn the money back. Which is worse in terms of the way people might react based on the way markets move if there's in fact a negative shock?
The surprising finding in the paper is that it doesn't matter if you're optimistic or pessimistic. Any deviation from the real world is equally painful in terms of welfare. Wow. Optimism is sort of obvious in the sense that if you take too much leverage, then negative shock causes a massive drain in your wealth and it becomes harder for you to recover. Surprisingly, pessimism also has a similar effect. Why? Well, because if you're too pessimistic, your exposure to capital market is very low, but the economy is still growing. The rational participants are still earning the high risk premium. So in a relative sense, you're losing a lot of wealth to the other participants who are taking advantage of high risk premium. And therefore, in the long run, you're going to become irrelevant. So in some sense, it is death by irrelevance in case of pessimism, whereas it's death by optimism in the other case.
So it sounds as though anything that is extreme in either direction will magnify the amplitude of the instability in the financial stock. I'm wondering if you can also distinguish everything we've talked about right now has been what they expect about the economy. When you say the economy, are you using that as a proxy for capital markets, or are you distinguishing in some way between the economy and capital markets?
So in our framework, there's a tight relation between capital market and the economy. In some sense, when the capital price falls, that drags down the whole macroeconomic growth. But the broader lesson still stays. The way you invest in capital market is related to the long-term growth rate effects.
So here we are in the middle of April of 2026. We have an economy that is doing relatively well, but I would say, and I've mentioned this a lot on other episodes of this podcast and in videos that I put out, that it's happening almost against all odds, and markets are climbing a wall of worry, but we haven't had any kind of instability in the form of excessive optimism or pessimism or major market moves in either direction. How would you portray where we are in this cycle and the risks or lack thereof associated with where we are in the here and now?
We are living in interesting times in the sense that if you look at valuation indices like CAPE index or any sentiment index, it seems very elevated. However, if you look at the surveys, especially Bank of America's survey, both the market participants as well as general retail investors are actually more pessimistic compared to a year before. So in that sense, I wouldn't say that we are living in dangerous periods. It seems there is a right balance between the valuation side as well as the belief side.
So I'm wondering about a lag effect with regard to attitudes. The CAPE index that you mentioned a moment ago has been between 35 and 40, more or less, for over half a decade now, since before COVID. And so you would think that by now, if there was any kind of a need to tamp down your expectations, that would have happened and that would be priced into the system right now. And yet we're not really seeing that with capital markets. And yet, by the same token, I just saw University of Michigan puts out a sentiment research on a regular basis. And the numbers that they're coming up with now, in the beginning of Q2 of 2026, are about as pessimistic as they've ever been. So what's interesting, I'm going to go back to this wall of worry that we're in a situation right now where independent, largely widely accepted academic indicators, maybe not PEs, but CAPE ratios, the Buffett ratio, other concerns that I think are legitimate as adjuncts, the $39 trillion debt level of the government in the US. These are all things that I think most people would rationally be concerned about. And despite that, I'm not seeing a lot of concern. To me, what that means is, based on your research, that if we have a major drawdown, that the net worth trap will actually be triggered, and that we could have a situation where a lot of people who have been proceeding on the basis that there's not a great deal of risk, or that they understand it and they manage it and they can control it, might be caught with their pants down and might not be able to respond. And as a result, the trap will be triggered and people will take risk off the table, and there will be inefficiencies. I don't want to put words in your mouth. I'm just saying that that's reading your paper and looking at the world today. That's what I think is being set up and what I think may happen. But what do you think?
You're absolutely right that on one hand, there are major concerns in terms of the debt sustainability in the United States, particularly, and the elevated valuations. But on the other hand, the sentiment measures indicate that investors are becoming too cautious. In any case, the big takeaway from the paper is that you shouldn't be thinking too much about the level of sentiments. You should be thinking about whether portfolios can survive a massive shock. In some sense, the key lesson as an investor is not to just think about risk and return like a financial advisor would tell you, but also to think about resilience, where resilience is a measure of how quickly you can rebound once a negative shock hits. Sure, the debt sustainability might be a big problem. We may enter a huge recession. We may also not enter a huge recession because of the AI boom. But regardless of what happens, make sure that you have enough discipline and enough planning before the crisis hits, because what my paper shows is that it's particularly the way you form beliefs during crisis that matters a lot for the long-term sustainability. And that means that even before crisis hits, your rebalancing rules, your liquidity triggers, your cash buffers, all those things have to be determined before the economy enters recession.
So what I think we're distinguishing here, and again, you can add some color if you wish, is between the real world and the normative world. You just explained what people ought to be doing, being resilient and revisiting things and rebalancing and making sure that you're going back to first principles and still okay with things. Do you believe people are doing that? We agree that that's what they ought to be doing. Are they actually doing that?
I don't think I'm qualified to answer that. I think financial advisors should look at what they're...
What's your impression?
My impression is that financial advisors implicitly are helping the clients in thinking about how resilient their portfolios are, but perhaps not explicitly. In some sense, in the mandates and in the client surveys, this should become an input as well.
I think we're getting ready to wrap this up. So we're going to keep this short here. Gautam, you're really, really fascinating. And one of the things that you may or may not know is that I wrote a book a few years ago called Bullshift: How Optimism Bias Threatens Your Finances. And so I'm very interested in the interplay between psychology and investor behavior. And so I want to thank you for your paper. Your paper came out after my book, so I only just came across it more recently. So that's wonderful. And I think there's a broad similarity between what you do, only you're a lot more empirical, and mine, I'm a little more anecdotal and sort of a back of a napkin kind of guy. But I think our findings are very similar. In this podcast, it's called Make Better Wealth Decisions. And I like to get my guests to conclude with some blanket advice with regard to making better wealth decisions. So keeping in mind what we're dealing with the net worth trap, What advice would you give investors of all walks of life, ordinary retail investors, to make better wealth decisions?
Build portfolios that can survive downturns. It's not just about risk and returns. Buying in dip is not enough. You should form portfolios such that you can quickly bounce back once your wealth level goes down. That would be the first advice. Second is always try to prepare before the crisis hits, because the way you form beliefs during crisis matter the most. Then you should be able to form beliefs in a way that allows you to rebound quickly. And third is think about the general equilibrium effects. Economists think a lot about general equilibrium, perhaps not so much the investors. But at the end of the day, it's not just about the capital that you managed, also the investment decisions of other groups, especially the more skilled groups, and the way, how much leverage they take and how that affects capital prices will eventually feed into your wealth. So those are my three big takeaways.
Gautam, I want to thank you for your time today. It's been a real pleasure, and I want to wish you all the best. And perhaps we could even keep in touch, because I enjoy what you have to say.
Thank you so much for having me.
If you're worried about the current investment climate and your money, go to my website to book a call for personalized advice to assist you in feeling secure and protected about your retirement.